Hi, welcome. It's Mary Ellen McGonagle, Senior Managing Director of Stocks here at Simpler Trading with your weekly show for Saturday, September 3rd. Today, we're going to take a look at some of the more impactful news that drove price action last week. Very dicey week, but at the end of the day, it was quite negative. We're also going to take a look at where the broader markets closed for the week, and then even beyond that, we want to see, is there a sector rotation going on? And all of this is about helping you prepare for not only next week but beyond. And then last up, viewer question of the week. And this is all about how you can use ETFs to potentially hedge yourself against the turbulence that's currently taking place in the broader markets. And first up, with that news that drove market price action this week, we did see the S&P 500 break below support and remain below that area. We will get into that. Also, earlier in the week, job openings increased as consumer confidence rose. And both of those items were viewed quite negatively by investors, as it really allows the Federal Reserve to resume or keep up their rather aggressive rate hike cycle in the face of increased employment, which in turn is keeping inflation quite elevated. And then last week, we also had several Federal Reserve presidents speaking at various events. The New York Fed president in particular did suggest that 3.5% Fed funds rate will exist well into 2023. More news that investors did not welcome. And relative to other areas, the price of Brent crude oil did drop below $100 per barrel. That is a benchmark that's viewed as very constructive for these oil companies, and a move below that did push energy stocks lower. We'll get into that as we move forward. And then also on Friday, we did get news that the unemployment rate rose despite a strong jobs report. So we did get very mixed economic data on Friday. At first, it was viewed as constructive because of that unemployment rate. However, at the end of the day, the markets did close in negative territory. We'll see how that information is digested over the weekend as we move into the fall period. Next week, pretty light on that economic calendar, which is not always good news because it allows the markets to be quite a bit more choppy as it digests very relatively little in the way of information. So from here, let's go ahead and take a look at where we closed the week on Friday. And here we are. This is a daily price chart of the S&P 500. And I talked about the fact that the S&P did break below support. And in this case, that is the 50-day simple moving average that occurred earlier this week. There was a rally attempt into Friday, as I mentioned, that did fizzle. So we closed the week below this key area, that is that 50-day simple moving average. Not constructive, particularly when you combine it with these momentum indicators. The RSI is below that 50 and heading downward, as are the stochastics down here in negative territory as well. From here, let's go ahead and look behind the broader markets and see how we ended the week with the 11 S&P 500 sectors. I've gone ahead with this 2-month daily price chart view and added this RSI. That is a relative strength indicator, descending order. So up here in this upper left area are your stronger areas relative to sectors down here in the lower right quartile that are weaker. The relevance here is you want to make sure that if you don't have representation in these stronger areas, make sure that you are not heavily weighted in these weaker areas. Also up here in the forefront of note is the fact that utility stocks, certainly a more defensive area, is up here in the forefront. But let's take a quick look here at energy stocks. It is showing superior outperformance or strength. However, it did not outperform last week. I'm going to share with you a weekly view here of the energy sector. It was down 3.5%. So one of the weaker sectors overall. However, it's still showing up in the forefront here because this relative outperformance prior to this pullback this week, and we'll get into oil prices and such as we move forward here. But let's take a look at some of these other sectors, and again, always on the prowl for potential sector rotation. But indeed, here we are with the technology sector down here in the furthest right quartile, the weakest area, and we did end down for the week almost 5%. And this was the second week of relative underperformance with the technology sector. And I will share with you precisely why tech and other areas of growth are being impacted as we move forward. So from here, I will share with you another 2-month daily price chart view of select ETFs that are really powerful in helping keeping you on top of what's taking place in the markets and why. So again, that 2-month view with that RSI, relative strength indicator, in descending order. So up here with your areas of strength, we can see the US dollar up front and center. We did see the dollar peak here or rise last week. Let's go ahead and take a look at a weekly chart, and I will share with you that the US dollar is at a relative new high. The importance here is that as the US dollar, it's viewed as a safe haven vehicle, and as that rises, you will see commodity prices lower. That's a rule of thumb. I will share with you the price of oil, one of those commodity areas here, using Brent crude oil, and here we are. This is the view of the per barrel pricing, and we are down now at this $93 per barrel. And I talked about that $100 pricing right in this level as being very relevant. Anything at this level or above really provides nice growth outlooks for these energy companies, but hence we are seeing a pullback here, and in turn overall energy stocks suffered. Other reasons that we are seeing a reduced pricing in the cost of energy and hence oil-related stocks is because of China's news that they have begun a reinitiation of their lockdown measures, only in primary cities, but they are major cities, and they do impact the demand for oil, and hence the price is lowered. Let's take a look at some of these other areas here up at the forefront showing relative outperformance to the upside. Here's a view of the yield on that 10-year treasury, and you can see it's continuing to tick higher. Higher interest rates or yields are negative for growth stocks, and in particular technology stocks. This is because it reduces the outlook for the growth for their earnings in the future. So higher interest rates, negative for growth stocks. Another area that is up here at the forefront, unfortunately, is volatility. This is the VIX index, also known as the fear index. And anytime we see volatility in this VIX index rise above this blue 200-day simple moving average, for a number of traders, this is viewed as quite negative. A secondary negative signal is when the 10-day crosses up above the 200. The green line is your 10-day simple moving average, and a cross up over that blue 200-day will signal a secondary negative view here. So also volatility is up here at 25.5. Ideally, we want that to be residing in this 18 level as a view that would provide us more confidence as the markets may potentially stabilize. Anything up above that level indicates a market that will trend lower as volatility rises. So moving along here, a couple of other areas of note is some technology areas. Here we are with a view of the semiconductor ETF, SOXX, and you can see the sharp decline that has taken place here of late, also occurring on high volume, negative RSI, negative MACD, and this particular area was down 7% as these high-tech semi-stocks continue to head south. From here, another area of technology that is a big part of the group is software. IGV is the ETF that's widely used, and we can see this area also was in a downtrend, down 4%. Your RSI in negative territory heading south, and likewise with that MACD now below this net neutral zero, so not good as it relates to the backdrop for semiconductor stocks. So overall, I'm presenting to you the fact that the broader markets are in a downtrend. Most heavily impacted negatively are these high growth stocks. From here, I did mention that I would talk to you about some of these ETFs, and in particular, those that have an inverse relationship to the markets or to an individual group. First up here, I am going to share with you SSG. This is an ultra short semiconductor ETF. Now, of note is the fact that this inverse relationship to semiconductors is very magnified. It's 3 times. In other words, if you do get involved in any of these inverse relationship ETFs, just note that if that particular underlying group were to stage any kind of a rally, your downside would have an ultra impact as well. But for now, we are in a confirmed uptrend. Nice high volume characteristics on this particular ETF with the emerging momentum indicators entering positive territory. Another ETF that we can take a look at that is also a reverse indicator, and this is going to be for the NASDAQ. This is QID, ProShares Ultra QQQ ETF, again 3 times. But what we can also note here is that QID this week broke back above this 50-day simple moving average, a nice uptick here in volume, but your momentum indicator, in particular your MACD, had this positive crossover, but just this week it is now entering into positive territory with a positive RSI. Now, one last ETF that I can share with you is relating to the inverse relationship of an underlying ETF, and this is the Tuttle Capital Short Innovation ETF. And in essence, this is akin to shorting the ARK ETF Innovation Fund. And we can see here, and I'll share with you that innovation ETF in a minute, but for now we are looking at an ETF that is trending higher. It's above each of its moving averages. Outside momentum indicators are positive and trending upward. So for note, this is not ultra, it's not 3 times, but it is an inverse relationship to this ARK Innovation Fund, ARKK, and you can see the downtrend taking shape in this particular ETF. So I will leave it at that. Everyone, I hope you enjoy the nice long weekend, and I will see you again here next week. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.